When trading, what every trader needs to use is a strategy. And that strategy has to include where you're going to enter and where you're going to exit. Now, the method a trader is going to use must be written in a trading plan before risking anything in the market. And your entry method should be based on some type of technical analysis with a trading indicator or even price action. So in this video, we're going to talk about using an indicator and price action to identify an entry point when we're trading stocks. Before I move on, if you wouldn't mind taking a second to click that subscribe button that's below. And while you're at it, feel free to like the video. Also, if you're interested in options trading, the link to download our Volatile Market Secrets Guide, it's free, it's above, and it's in the description. It's a great little guide. So we're going to look at two distinct long entry strategies. One is finding an entry using the MACD indicator. Second, price action. The MACD is actually pretty popular, and MACD stands for Moving Average Convergence Divergence. That's a mouthful. Simply, we're just measuring the momentum in the market. And the MACD is calculated subtracting the 26-period EMA from the 12-period EMA, and then a signal line is created by taking the 9-period EMA of the MACD. We have a histogram we can use. I'm not going to put that on these charts. I don't use it. Essentially, it just further measures momentum, takes a difference between the MACD and the signal line. Now, we can use the indicator to trade stocks by finding divergence between price action and the indicator. We have bullish divergence. That's when the stock price makes a new low, but the MACD starts to make a new high. Now, this indicates that momentum is starting to shift and the stock may be ready to move higher. I say maybe because nothing's guaranteed in trading. The bearish divergence is when the stock price makes a new high, but the MACD begins to head to the downside. This is an indication that momentum is starting to shift and the stock may be ready to move lower. There's other forms of divergence, but let's just keep it simple. Now with the chart, you can see on the left, price made a lower low, but the MACD made a higher low, bullish divergence. On the right, we have two peaks. And while that last price peak is higher, MACD made a lower high. It's bearish divergence. If we're looking at entering these trades, we can enter on a break of a downsloping trend line with your stop loss at the lows. It's very, very viable approach to trading. The second setup is we're just using a variant of the 2B reversal. So once price reclaims the previous peak, which means come back inside, we can look to trade. The stop loss goes above the high of the pattern. And bearish divergence, when trading stocks, we're probably looking to lock in profits on our longs or in some cases exit the trade. This is a bullish divergence example on a 65-minute chart. Most traders trading stocks are going to want to focus on the bullish side of things. Here, price makes a new low, MACD starts to go up. Your trade entry can be off a reclaim of prior support. Again, that's when price breaks back above, when it's accompanied with a bullish candlestick. A trader could also enter after a down trend line is broken. We saw that earlier. In either case, your stop loss is better served under the extreme low of that pivot move. We need profit targets, and they come in so many different variations. You can use trailing stops to a multiple of your risk. It doesn't matter. You just have to pick one that you're comfortable with. We have a lot of videos on our channel. Just search for profit targets. So when we look at a chart, we want to find bullish divergence and use those to our advantage. Again, a bullish divergence occurs when the MACD is making higher lows while price is making lower lows. This indicates momentum is starting to shift. The stock may be ready to move up. And to confirm this, we could see a break of the downtrend line. This is where you'd enter the trade. Stop loss, again, below the low of the most recent low. Your target price could be set at a prior resistance level for simplicity's sake. This setup could actually have a really good risk to reward ratio. Could lead to some really nice profits if you've caught the change of a trend, which can happen. We're talking about price action. There's so many different ways you can use price action to find a trade entry. One, it's a simple candlestick pattern. They come in reversals or continuation patterns. Reversals occur when the market changes direction. So you'd enter a trade in the opposite direction of the previous direction. Continuation patterns, that's just when the market continues in the same direction. And there's a lot of different ones you can use. Just choose ones that you could easily read. Because remember, the pattern, it's not magic. It's just simply telling us who is winning the buying and selling battle at that point in time. Here are 4 good ones to start with. A hammer, it's a candlestick, has a small body with a long lower shadow. Like to see this when the market's falling and reverses to close near the open. Long lower shadow, what does that say? Tells you that there was some selling pressure, but the buyers wiped them out, pushed the price back up. Inverted, it's the opposite of the hammer. Small body, long upper shadow. Market's rising, reverses to close near the open. That long upper shadow, there was some strong buying pressure that day, but the sellers pushed it right back down. Bearish engulfing, 2 candlestick pattern. We want to see it when the market's rising. That first candlestick has a small body. The second candlestick has a large body that completely covers the first candlestick's real body. Some traders do prefer the entire price range of that previous candle to be wiped out. It's a bearish reversal pattern. A bullish engulfing pattern, it's the opposite of the bearish one, forms when the market's falling. That's when we want to find it. Now, these are going to show up all over your charts. Okay, so location is going to matter. So where can we look at these? Support and resistance levels. Now, these are important levels where the market has reversed in the past and it may do so in the future. And these levels can be used as a launching point to enter a trade in the opposite direction. How do we find them? Identify the most recent swing high and swing low. The swing high is the highest point the market reached before it started to fall. Swing low is the lowest point before the market started to rise. Just draw a horizontal line at the swing high and one at the swing low. Area between those two lines, we're going to call it the trading range. So now the market will often reverse at these levels, the support and resistance levels, although you will see at times it's going to head right back into the range. So here we have a hammer forming at an area where price had to break through in the past. This is a resistance level turning to potential support because it could still fail. You would look to trade a break of the hammer, the high of it, stop loss goes below the low, and have some type of trading plan for profit taking. Here we have a bearish engulfing candlestick at resistance on a daily chart of Levi forming. But before you take any action on these candlesticks, you want to wait until near the close of the period. So near the close of the day or near the close of the period you're using, like close to the end of the hour. The downside with that is the closing price could be far from the high of the candlestick. So it's going to give you a large risk profile for the trade in this example. Let's combine them all because we've learned how to find and use divergence with the MACD. We have a few different candlestick patterns we can use. We know what support and resistance levels are. Let's combine them. This is a 15-minute day trading chart. Price has pulled into a zone and acted as support in the past, the black line. The MACD is showing us bullish divergence because price made a new low. We see the hammer show up at support during bullish divergence. Now, it's not a perfect hammer. It's red. But the next candlestick gives us a hammer closing green. Enter above the highs. Your stop would go below the lows of those candles. Let's talk about trend lines. Can't ignore them. They are used to identify the direction of the market. But we can also use them as entry signals in the direction of the trend, as we saw in the MACD example. How do we draw a trend line? Pretty simple. Find at least 2 points that the stock is touched. Draw a line connecting those points. So if the stock is in an uptrend, you want to find the most recent low points, connect it to the previous low point. This will give you an upward sloping trend line. It's going to project into the future, and you can use that to look for setups if price touches it again. Stock is in a downtrend. Find the most recent high point, connect it to previous high points. It's going to give you a downward sloping trend line. And again, you can use it to find trading opportunities if price comes back to it. Now, the trend line can also be used as an entry and an exit tool, a trigger. So for example, let's say this stock, well, it is in an uptrend. It breaks a down sloping trend line, right? You can enter a long trade. This chart, you can see it's an uptrend. There's various pullbacks to areas of interest. That's those light lines. So you can combine these trend lines with the MACD divergence and various candlestick patterns to enter. You can look for hammer candlesticks, bullish engulfing at the bottom of the trend channels to enter trades early. You can even use multiple trend lines to find more advanced trading opportunities. For example, this stock is in an uptrend, and let's say it touched a longer term downward sloping trend line. You may want to consider a short trade. This is because the stock is still in an uptrend, but it could be starting to show signs of weakness. At the very least, you would want to watch price action for any weakness if you were in a long trade. Using multiple trend lines, it is advanced, but you could find more opportunities that you may miss if you're only using one trend line, but you have to be comfortable with counter trend trades. To wrap this up, if you can identify bullish divergence and you can combine them with trend lines, you could find good entry points for a trade. Done properly, this can be a very profitable strategy, but you cannot ignore placing your stop losses. Now, you have to stay disciplined, right? You don't enter a trade just because you see bullish divergence. Make sure the stock's actually starting to move higher before entering. Otherwise, you could just enter the trade, take a loss without any real movement in your direction. Do not ignore support and resistance levels. They are important. These levels can give you an idea of where the stock is likely to find buyers or sellers, and it could help you make better trade decisions. Price action could be very helpful in finding these levels. So if you see a stock start to bounce off of a certain level, that may be an indication that it is a support or resistance level. How do you know? Look to the left, see if there's a swing level or a price structure that reversed price in the past at that level. You got to remember, these levels are not going to be exact. Okay, the stock may trade above it or below them. It's going to happen. However, they can still be useful in giving you an idea of where the stock is likely to go if price action divergence is setting up. Make sure you hit like, subscribe, download that free options book, and we'll talk to you soon.